Good morning and welcome back to Almus Market Mornings. Well, the Federal Reserve's interest rate decision didn't disappoint the market. They cut rates by 25 basis points. And interestingly, there were three dissents this time, two to keep rates unchanged and one for a larger 50 basis point cut. Rate outlook for next year remains uncertain, while members projecting one rate cut. Growth is expected to be higher. Meanwhile, the Fed is also going to restart the QE. Good morning, JK. How will you rate this policy decision? Would you consider this hawkish, considering there is also the QE that is being restarted?
Good morning, Swaraj. I think market was prepared for a hawkish cut, and that has actually been a departure from what we have seen in the Fed yesterday. While they have cut quarter percent, in the rate cut in the rate, as well as projected only one rate cut each in 2026 and 27. The subsequent decisions and also the statements from Powell indicate some sort of a dovishness, and that's par for the course because Powell and his company have to take the decision in the absence of official data on the economy, which has been missing for some time now. I think in fact, when Powell sounded quite dovish when he said that central bank's next move is unlikely to be a rate hike. He also added that the rate increase is not the base case reflected in the new projection from policymakers. So the summary of economic projections was not too different from the one which we saw in September, except that in the growth they've actually slightly revised it upwards, but more or less the unemployment rate, PCE expectation, as well as the rate projections have remained same as September. But we should take this with a slight skepticism, because once we have more data on the economy, these projections could actually see some changes as well. Now, central bank also started new liquidity measure through purchase of T-bills in what is described as the reserve management purchases. Now, recently we have understood that the market liquidity has been tight, and there's more access that is being resorted to by the banks on the Fed's repo facility. And in order to see the market function smoothly, Fed has resorted to this. I wouldn't call this as a QE, because first of all, it is a program where they buy short-term T-bills, and secondly, these programs can end anytime. Depending on how the market's liquidity position is. However, it still means that we have more liquidity in the system, and the markets normally look at how the liquidity situation is when they react. So that was the one of the main triggers why we saw markets react positively. While they were prepared for a hawkish hike, the statement from Powell, as well as the decision to infuse more liquidity into the system, coming earlier than what the market was probably expecting, added to bullishness in the market. We saw the dollar index fall by about 0.7% against major currencies. Then gold rallied back to 4,240 per ounce. Stocks gaining, as well as the bond yields also, in fact, taking a dip on after the decision. Now, post the meeting, market, of course, is discounting a no cut or hike in the next meeting. That is a pause. The probability is around 78%. However, for the year 2026, market still discounts two rate cuts, whereas the dot plot indicates only one rate cut. I think the market is still a bit dovish. Also, in encouraging the market, is statement from Kevin Hassett, who is probably the front runner to be Fed's new chairman. In one of the events, said there was plenty of room to cut interest rates further, although he added that inflation rising more can change the calculations. Yesterday, we also had employment cost index data, which showed that the wages were not rising as much as it was earlier. Wages increased just by 0.8% compared to 0.9% that was expected. I think overall, even Powell described this particular data as indicating that US is not a hot economy. Market got what best they could get under the circumstances, and that's the reason why we have seen rally. So as far as the dollar index concerned, it is back near 98.50. That's about a 0.7% lower from where it was trading earlier in the week. Technically, if you look at dollar index, it has been unable to hold above the psychological 100 mark despite several attempts. And with yesterday's move lower, it has also been trading below the 100-day moving average, is also seen as some sort of a technical break. However, it's important to see whether this break holds. Overall, if you look at other currencies in Europe, the data has been steady to stronger. In Japan, there is speculation of a rate hike at next week's meeting. And other central banks like Australian Central Bank and the Canadian Central Bank, who have held the rate steady, there is a possibility that the rates have seen a bottom, whereas in US, there is likelihood of more rate cuts. So overall support for the dollar is limited, and we could see some more easing in the dollar, although till the year end we could hold the ranges. My expectation for the new year, of course, with some more analysis that is required, with more data that is coming in the upcoming, I would still think that in a broader picture, dollar is going to enter a fresh bear phase next year. However, we should also look at how the bond market performs, considering the recent big rise in the yields in the US as well as in the other regions as well. As well as rupee is concerned, we have seen some two-way action. Exporters are also active above 90, but demand persists around 89.80. There's a focus on trade talks which are ongoing currently in India, with the US trade representatives being here. One of the statements indicated that the recent offer from India has been the best. However, the bone of contention is about the agricultural products, and so I think that is something which is stalling. Market is not so optimistic as they were about a month or two before. So I think if the trade deal does happen in this month, that could be a positive surprise for the market, and the rupee could see some good rally based on that. Other than that, we're still seeing the FII number being negative, and Indian stocks continuing to underperform the global peers as well. One good thing, silver lining on the horizon is large amounts being dedicated for investments by the big tech companies, Google, Microsoft, and even Amazon. Now, the promises of about 70 billion investments in the coming years. So that's one positive vibe for the rupee. However, for the time being, we continue to trade the range of 89.70 and 90.20 for the rupee. Of course, with the Fed meeting over, BOJ next ahead. I think once these events are over, market is probably going into a holiday mode as well. Thank you.
Thank you, JK. And with respect to the Fed meeting, I think one of the highlights was the purchase of T-bills. It's actually not QE, it's for reserve management, and that's so that the liquidity position improves, and it may be stopped as well once this position sort of gets better. But overall, markets, I think, took it with both hands. Rates, what was expected was the central bank to be quite hawkish with a rate cut, but what they got was, even though from the rates point of view, we were sort of more conservative, but we got this liquidity injection as well, which is like a market positive. So the general reaction has been good. Yields have taken a dip post the decision. Dollar was sold across. Markets are discounting a pause in the next meeting, while for 2026, two rate cuts are still being anticipated. When it comes to rupee, we are seeing two-way action. Above 90, there is some dollar selling, while around 89.80, we are seeing some dollar buying. Trade talks, they are still continuing, though there are some thorny issues that need to be resolved before a conclusion can be come to. That's it from us today. Thanks for listening. We'll catch up tomorrow with the fresh round of updates.